Welcome to the deep dive. If you're looking for a shortcut to understanding what's really driving the global economy, you are in the right place. Today, we are wrestling with a profound paradox that really defined the markets on December 4th, 2025. I guess you could call it the market's cognitive dissonance.
That's a perfect way to put it.
So our mission today is to look at this one really intense snapshot of global finance. Because on the one hand, you have U.S. stock indexes, the S&P 500, the NASDAQ, they're soaring. They're holding near record highs.
Right.
But on the other hand, the foundational economic data, especially on jobs, is shockingly weak. I mean, it's getting worse.
It is.
So we're going to unpack the why. Why is deeply bad economic news being celebrated by investors? And what are the two massive structural shifts, one tech, one geopolitical, that are really underpinning this whole contradiction?
It's such a fascinating moment because what the data is showing us it's far beyond just a typical cyclical slowdown. We are witnessing a structural remodeling of the economic landscape. And this whole shift is being driven by, the rapid deployment of artificial intelligence and at the same time, some significant new frictions in global trade policy.
Right.
And those two forces together are creating these really unique challenges for central banks, and they're translating directly into pressure on consumers all over the world.
Okay, let's jump right into the data that really signaled this weakness, and that's the Challenger Job Cuts report for November. The scale of the labor loosening here is, it's pretty hard to ignore.
It truly is. It paints a picture of, corporate caution and some really aggressive streamlining. U.S.-based employers announced 71,321 job cuts in November.
And that's a big number.
It is. And crucially, while it was lower than October, it was still a 24% increase compared to November of last year. It's actually the highest figure for the month of November since 2022.
And when you step back and look at the cumulative figures, the year-to-date numbers, the situation gets even more stark.
It does.
I mean, year-to-date cuts through November have hit, get this, 11,170,821. You just have to pause on that number for a moment.
That's a 54% increase from the same period last year. For context, it's only the sixth time since 1993 that the annual cuts have gone over 1.1 million.
And it's the highest year-to-date level we've seen since the immediate shock of 2020.
And you can't just look at the layoffs in isolation, right? You have to look at the lack of confidence in expansion. The planned hiring data shows this extreme corporate caution.
What are those numbers looking like?
Well, year-to-date planned hires are down 35% compared to last year. It totals only about 497,000. That's the lowest amount of planned hiring that's been recorded since 2010.
Wow. So it's a double whammy.
Exactly. Companies are shedding jobs fast, and they're refusing to staff up for the future.
So that really begs the question, right? How do we know this isn't just a standard cyclical recession? Because if it were just a downturn, you'd expect to see companies kind of trimming fat equally across the board.
That's the key distinction here. The causes that are being cited for the cuts point directly to structural change. The leading reasons in November weren't just, economic uncertainty. They were restructuring, which was over 20,000 cuts.
Okay.
And closings, which accounted for another 17,000. Companies aren't just slowing down. They are fundamentally redesigning themselves.
And the most significant piece of that redesign, based on everything we're seeing, is the explicit role of artificial intelligence.
Absolutely. AI is no longer this, theoretical job killer. It is an active catalyst. It was explicitly cited as the cause for 6,280 cuts just in November.
In 1 month.
In 1 month.
Yeah.
And if we look at the total data tracked since 2023, AI is responsible for a really significant number of job eliminations. This is a targeted displacement event. It's hitting administrative roles, knowledge workers, and technical staff in key industries.
And the sectors reflect that, don't they? I mean, telecom was hammered, over 15,000 cuts in November, and a lot of that was Verizon streamlining. Then you have tech companies announcing over 12,000 cuts, which brings their year-to-date total above 153,000.
So this structural thinning is heavily concentrated. It's in high tech, it's in white-collar fields, and it's often directly replacing human tasks with automation efficiency.
Okay, now here's where the market's mind game really begins. Despite this incredibly grim labor data, I mean, the highest YTD cut since the pandemic U.S. stock indexes soared. The S&P 500 rose, the NASDAQ gained.
Yeah.
So why are investors treating massive layoffs as a positive development?
Because right now, investors are looking past the present pain. They are focusing almost entirely on one thing:
The Fed.
the forward policy path of the Federal Reserve.
Yeah.
They see these deeply negative structural employment figures not as a signal of a deepening economic hole, but as confirmatory, undeniable evidence that the Fed must pivot.
So in the market's view, the Fed's dual mandate price stability and maximum employment, it's been fundamentally broken by AI displacement, and that forces the central bank's hand.
Precisely. It's a structural realization. The market is pricing in that anticipated December rate cut with very high conviction.
What was the probability?
Futures were pricing an 89% chance of that move right after this data came out. So in the eyes of the market, this labor loosening completely justifies immediate monetary accommodation, regardless of how stable inflation might seem.
And we see that same tension, that same paradox in how corporations are allocating their own capital. I mean, just take the really instructive story coming from Hewlett-Packard Enterprise, HPE.
Yes, HPE, the enterprise tech giant, missed its Q1 revenue forecasts. They were expecting $9 to $9.4 billion versus a much higher $9.9 billion estimate.
And the stock took a hit.
It did. Shares immediately sank 5%. And the company explicitly cited cautious enterprise spending amid economic uncertainty.
This brings us to the core corporate spending paradox, and this is where it gets really, really interesting.
It is.
HPE noted that while companies are investing heavily to build out AI capabilities, they are at the same time engaged in severe, painful cost optimization on all their existing hardware.
Right, the legacy compute, storage, networking products that HPE specializes in.
Exactly.
Think of it this way. It's like companies are pulling the plug on their outdated landline systems, cutting costs mercilessly there, just so they can afford to buy a brand new, expensive, state-of-the-art satellite phone system.
So the budgets aren't shrinking entirely.
Not at all. They're being aggressively rerouted. Capital is just pouring into specialized AI infrastructure, which validates the huge AI tech boom, while the legacy standard IT departments suffer these deep budget cuts. It's an aggressive, structural reallocation of money, not a passive freeze on spending.
Okay, so if corporations are aggressively tightening their belts on legacy spending to afford this AI future, how is the consumer holding up against that backdrop? The earnings reports from the retail sector, they show just a startling stratification, what we're calling retail bifurcation.
It is a very, very clear signal of financial strain. You see two completely opposite stories playing out at the same time. On one side, you have Dollar General, DG. They reported impressive strength. They raised their annual profit forecast, they beat their Q3 estimates, and that sent their stock up about 10%.
And their strategy really explains why. They lean so heavily into that value proposition, right? They keep about 25% of their products at or below the $1 price point.
Which serves their core customer base households, earning less than $35,000 incredibly well. But the critical nuance here is the trade-down effect.
Right.
DG's CEO specifically noted that the company is well-positioned to increase market share with customers across all income brackets.
Meaning it's not just their core customers anymore.
Exactly. It means middle-income consumers, the ones who traditionally shopped at conventional grocers, are now consolidating their spending and trading down to discount channels because their own household finances are tightening.
And the other side of that coin, the other side of that bifurcation, is traditional retail. So in stark contrast, the grocer Kroger saw its stock dip 4%.
Right. After missing sales expectations and issuing weak guidance, the contrast just couldn't be clearer. DG is up, Kroger is down.
Consumers are aggressively seeking value, and they're trimming anything that's not essential.
And we can trace that pressure directly back to policy. The current consumer financial strain is being significantly exacerbated by the new tariff regime.
Okay, how so?
Well, analysis estimates that the new trade rules will translate into an average tax hike of anywhere from $1,300 to $2,400 per household.
Can you just walk us through that? How does a tariff on imported goods actually function as you put it, a tax on domestic consumption for the average household?
Certainly. So when a tariff is imposed on, say, imported clothing or electronics, the foreign manufacturer and the domestic retailer selling that product, they face a higher cost.
And they don't just eat that cost.
They rarely absorb it entirely. No. Instead, they pass that cost increase directly onto the consumer through higher retail prices. So the American consumer is effectively paying the tax hike, whether they think they're engaged in global trade or not.
So that's the core headwind. That's what's fueling this strain and this urgent rush for value at places like Dollar General.
Precisely.
That makes the connection much clearer. Okay, so let's widen our lens to the global picture. How are the Eurozone and global policymakers reacting to the U.S. situation and these structural headwinds?
On the European side, the European Central Bank, the ECB, they seem relatively comfortable, at least on the surface.
They're holding steady.
For now. ECB members largely agree that current interest rates are in a good place and that monetary policy they're doing patience, but they're also deeply focused on the external risks that are coming primarily from the U.S. trade stance.
And what are the key risks that the ECB is actively monitoring? What are they worried about?
Well, ECB Executive Board member Cipollone highlighted three critical, sort of untested risks. First, they're watching the full effect of the U.S. tariffs on the overall European economy and their trade flows.
And second,
Second, they anticipate potential inflationary pressure from Chinese goods that are being redirected, basically pushed out of the U.S. market by tariffs and then flooding into Europe.
so Europe might be importing deflation in some areas, but then risking cost push inflation in others because of these geopolitical trade shifts.
Exactly right. And the third risk is tied to consumer behavior. The ECB is assuming that a decline in the consumer savings rate is going to fuel a recovery in consumption.
And that might not happen.
Well, if U.S. tariffs are straining European consumers as well, that assumption that they're just going to open up their wallets, that could easily be proven wrong.
Meanwhile, the high expectation of a dovish Fed pivot here in the U.S. is driving this generalized U.S. dollar weakness. We're seeing the DXY, the U.S. dollar index, under a lot of pressure.
They are.
What does that dollar trajectory really tell us about the market's conviction?
Well, the DXY is just the measure of the dollar's strength against 6 other major currencies, and its weakness signals this high conviction that the U.S. will ease monetary policy sooner, and probably faster, than its peers like the Eurozone.
So what are the forecasts saying?
Currency strategists at JP Morgan are already forecasting significant dollar depreciation. They anticipate Euro-D reaching 1.12 and USD JPY falling all the way to 140 by the end of 2025.
Wow.
Yeah, this reflects a broad market consensus that the Fed's path is, well, it's pretty much fixed.
And this feeds directly into the performance of safe haven assets. I mean, gold and silver are showing remarkable strength, and that's largely fueled by those dovish Fed signals.
Absolutely. The primary mechanism there is the reduction of the opportunity cost.
Right.
When interest rates are expected to fall, the cost of holding a non-yielding asset like gold or silver goes down, which makes it more attractive. But silver is the real standout performer here. And that's because of its dual nature as both a monetary metal and a critical industrial commodity.
Tell us more about that, the structural industrial demand for silver.
Well, silver is facing a fundamental structural supply deficit. For 4 years in a row now, demand has actually outstripped supply. And this isn't just about investment.
This is industrial use.
This is driven by robust, increasing industrial demand from 2 accelerating trends. The green economy transition, so solar panels, electric vehicles, they are highly silver intensive.
And the second one.
And critically, from the demands of the AI sectors that require specialized electronics. Forecasts are projecting 5–7% annual growth in industrial silver demand all the way through 2026. It is a strategic metal for the future economy.
So we've really covered the entire loop today. We've seen the stark reality of job cuts driven by automation right alongside stock market resilience driven purely by policy expectations. The defining structural forces in the economy right now seem so clear. AI is driving the labor shift, and new trade policies, the tariffs, are driving a future cost shift onto the consumer.
And this creates a truly unique policy challenge, especially for the Federal Reserve. The Fed feels compelled to cut rates because of the structural labor loosening caused by AI displacement. They're trying to support employment. But those same tariffs are estimated to hit consumer prices and introduce a high risk of imported cost-push inflation heating up again later in 2026.
So this divergence creates this high-stakes policy trade-off. You cut rates to deal with unemployment from AI, but then you risk unleashing a second wave of inflation that's fueled by tariffs.
The traditional policy tools suddenly feel inadequate for the unique problems we're facing.
And that takes us directly back to the robust rally in gold.
It does. Gold serves as the market's ultimate policy hedge. It signals that investors are betting on a future scenario where these structural forces, AI-driven job displacement and tariff-driven inflation, make the Fed's traditional tools, like interest rates, just less effective. They are seeking tangible assets as a long-term buffer against profound structural policy uncertainty.
It's a profound thought for you to carry forward. The market is betting the Fed will blink first in the face of AI displacement, but that relief may come at the long-term cost of tariff-driven inflation. Investors are already hedging against policy failure. So the question is, are you ready for an economy where bad news is celebrated and the rules of the game are fundamentally changing? We appreciate you diving in with us today.